I think there's an opportunity there with the elimination of the basis reduction to get some extra equity into the deal while still delivering potentially an out-of-market return for investors for a similar asset if you were just to take them both in a single tier.
Welcome to Buzz House, a Baker Tilly podcast where you can find all the buzz around multifamily housing. I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice.
And I'm Garrett Gibson, a partner at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Each week, we'll bring you a guest or a topic in the multifamily housing industry that will help you win now and anticipate tomorrow. Let's get started. Today, our guest in the Buzz House is Mark Cohen, who is the Managing Director of Federal Tax Credit Investments for Fallbrook Financial Services Company. We'll be talking with Mark today about combining LIHTC and historic tax credits, otherwise known as twinning. Before having a discussion with Mark today, I want to give you a few updates from across the industry. A lot of our time today is going to be around state low-income housing tax credits, a lot of activity across the country. I'll just give a few highlights. I think there's as many as a dozen states right now that are considering or proposed legislation around state historic tax credits. Very specifically, in the state that I reside in here, Wisconsin, Governor Tony Evers' proposed budget came out recently where there are two significant housing matters. The first is a grant program for local municipalities to encourage the development of affordable housing, which would provide up to $50 million of funding in 2022. Probably more significant of that is a proposed change to the state local housing tax credit program to address, obviously, the needs of affordable housing, increasing kind of the annual allocation of state tax credits available from 7 million to 10 million. And then very interestingly as well, extending the tax credit period from 6 years to 10 years. So kind of factoring in the price differential, the timing differential, it's probably almost 20% more equity would come into a deal. And then obviously increasing it from 7 to 10 million, so another, 30% more credits. So kind of exciting. We'll keep our eyes on that. Last time reported on the Buzz House, Iowa currently has a proposed legislation to provide for $15 million in state housing tax credits. It'd be a 10-year tax credit period. Additionally, Iowa has a workforce housing tax credit, and there's a proposal to double the amount of that budget authority as well. So from what we hear, that is very likely to pass in Iowa coming up. The state of Montana has recently introduced legislation for a state workforce housing credit. That, again, would match the amount of the federal low-income housing tax credit. The statewide cap would be 50% of the federal 9% cap in any year. It would be a 6-year credit. So we're kind of seeing, obviously, a trend of either 6 or 10-year credits. Finally, proposed state local housing tax credit in the state of Illinois. This would be a 10-year tax credit. There'd be $35 million available each year, with 75.5% going to IDA to be allocated, and the balance, or 24.5%, would go to the city of Chicago. So very exciting. Those are just four of the, like I said, almost I think a dozen states right now that are contemplating a state low-income housing tax credit. Again, just is neat to see this in the state and national kind of dialogue. Kind of one last update before we jump into a discussion with Mark is in response to COVID-19 and the economic fallout, many cities and states are creating and expanding their rental assistance programs, right, to support individuals and families, of course, impacted by the pandemic. Very helpfully, the National Income Housing Coalition is tracking in-depth information on these various programs. And we'll put this at our podcast link, but right now the LIHTC document is tracking some 440 rental assistance programs around the country in response to the pandemic. So again, we'll list that out there. So again, we know many owners of housing are helping their tenants and so forth, maybe access some of these resources. And yeah, 440, just a kind of a crazy high number across the United States right now, and probably more to come. So with that, Garrick and I will jump into our discussion with Mark. Garrick?
Thanks, Don. That was a great intro. Interesting on the 440 rental assistance programs being tracked. I want to see what kind of comes out of that. But for now, let's jump in. We have Mark Cohen here from Fallbrook. And Mark, why don't you go ahead and just give us a little bit about your background for our listeners?
Yeah, sure. Thanks, Garrick, and thanks, Don. So I started in the industry back in 2005 as an accountant with Cohen Resnick. Got my feet wet, spent a decade there. That's where I met you, Garrick, as as you all know. But yeah, represented high net worth individuals and corporations in tax motivated investments, closed over $500 million worth of tax investments. Then started a syndicator in 2015, focusing on historic credits, closed about $25 million of historic equity for 2 high net worth individuals. And then with the passage of TCJA, lost our investor, joined Fallbrook, and certainly excited to be here. It's been about 3 years since I joined Fallbrook. We've been a major player in the LIHTC space since the inception of the program in '86, focusing on both federal equity, state equity. We launched a debt platform in 2015, but I joined with a primary focus on launching a federal historic tax credit program, and have been closing deals, ever since we joined. One today, actually, just before we jumped on a call. So certainly an exciting time, and I'm excited to be here. So, thanks for having me on.
Well, congratulations on that closing. So obviously, you're dipping into a lot of things being at Fallbrook. So how are they specifically involved in the financing of affordable housing projects?
Thanks, Garrick. So we have a private placement program for long-term tax-exempt debt where we buy, 40-year paper for 2 capital partners. Programs designed to compete directly with the HUD 221D4 program, but best part about our program, or the upside of using us compared to HUD, is 1, time to close. We don't take roughly a year, and 2, you don't have to use Davis-Bacon wages as a part of the construction. So those 2 reasons are generally why we're seeing developers come over to Fallbrook. Also, when you do come to Fallbrook, you have the opportunity to be a one-stop shop for a debt and equity execution. And as noted earlier, the deal we closed today was a 199-unit deal, actually in Austin, senior deal, roughly $30 million construction loan and $11 million of equity. So pretty nice deal to get done just before this podcast.
Perfect. Now, I know you've been involved a lot on the historic platforms, and so I kind of wanted to, steer the focus to say, I've seen a lot of historic combined with low-income housing credits. As a matter of fact, historic credits have been, combined with a lot of different types of subsidies like opportunity zones and also like even with new market tax credits. So as far as on the low-income housing tax credit combination with historic credits, what kind of trends are you seeing in this market?
Yeah, so we're seeing a couple of capital providers pretty much dominate that market. We have a couple of proprietary investors who are comfortable with a twin structure. They prefer single tier. There are certain deals where we've considered, although not actually closed, on a master lease pass-through structure. Obviously there are advantages to the developer, to the investors for various structures. I think it really comes down to what the needs are of the individual deal. Like I was looking at one earlier today where we know going into it that we're going to have to do a bifurcated structure. Just the sources and uses won't balance without it. Generally speaking, it really comes down to, when it comes to structure, what the attorneys are comfortable with. So certain investors will really make it look like a safe harbor investment from the historic perspective. And so they'll try to take a 1% interest and make sure that, the master tenant has that 1% interest in the landlord, and then everything at the master tenant is quote unquote revenue procedure compliant. But then on the LIHTC side, you're generally structuring that as a straight LIHTC investment. And so I think there's an opportunity there with the elimination of the basis reduction to get some extra equity into the deal while still delivering potentially an out-of-market return for investors for a similar asset if you were just to take them both in a single tier.
So in a single tier, I guess the low-income housing tax credit investor is taking obviously the federal historic and the low-income housing tax credit investment with that basis reduction. Is there any pricing differences that you see in that single tier versus this master tenant structure where you have 2 separate investors? You have a historic investor and the tenant entity, and then on the landlord entity, that's the tax credit investor side of it. Are you seeing differences in pricing between the historic and the LIHTC in these structures?
A little bit. Generally speaking, you'll see lower pricing in a bifurcated structure because there's additional benefit to the project. Some of that will be captured by the syndicator, some of that will be captured by the investor, and some will be captured by the project. It really all comes down to making sure that the sources and uses balance, though, right? And so everybody is getting a slightly better deal, and the question is how much are the investors and syndicators willing to share with the sponsor?
So that being said, obviously there's benefits on the historic tax credit side where they have to, obviously there's some cash driven items for them. But what about other things like, developer fees for a low income housing tax credit project? Typically, they'll have, depending on the agency, maybe 10 to 15 years to pay it off. And I know in a historic transaction, there's a 5-year compliance period. Are they still looking for the developer fees in these twin type of transactions to still be paid off within that 5 years?
That depends on your counsel as well, but generally speaking, no. Not that you need to pay it off in 5 years in order to include it in basis. I presume that's where you're going with this. But because you don't run into the same tax issues because you have a corporation owning 99% of the landlord, and it's not an individual, you don't run into the same at-risk issues with respect to payment of the deferred fee. So most of the time you see attorneys being comfortable with that deferred fee on the LIHTC side and the historic side getting paid off in 13 years.
Interesting. So obviously the benefit flow is just different per each one of these type of structures, whether it's single tier, meaning it's one partnership and it's the same investor grabbing, historic and LIHTC credits, and then bifurcation where you have two separate investors. So in these types of execution, what's the ultimate, is there any differences in the types of debt products that you'll see on here if you have those types of twin structures in a master tenant structure?
Generally, I don't see much of a difference in the execution of the debt. Fallbrook, if it's a twin 4% historic deal, we oversize our construction loan to act as a tax equity bridge. So you're getting at today's taxable rates of somewhere between 5 and 5.25, a tax equity bridge on what's normally a pretty significantly or pretty heavily deferred historic equity investment. That's probably the biggest change in the debt execution, but generally speaking, we're not seeing much of a difference. We're still penciling to make sure that we're at 115 at all times, assuming your debt service constrained. Yeah, I'm not seeing many differences in the debt. On the cash flow side or on the investor side, from the historic perspective, I think the question is, in an affordable deal, is there enough money to pay a pref? And if the answer is no, then you're going to see reduced pricing and you'll see a reduced put. But, from a developer's perspective, that's great because there are essentially no holding costs associated with the equity investment on the historic side. As we all know, generally speaking, in a LIHTC, in a straight low-income housing tax credit deal, most, if not all, of the cash flow is reserved to pay deferred developer fee or feed out to the general partner in some way. And so, I think in a twin deal, ultimately the investors are trying to solve to that same purpose, right? And serve the mission and not, take extra benefits out of the deal just because they can.
Great. Yeah. I suppose if you have a lot of areas of the country that do have a lot of historic buildings that could be converted into affordable housing projects, it's great that we're discussing this because it seems like there would be a lot more coming up, given the fact that a lot of development seems to be moving, other than suburbs, obviously, the COVID items. But I've seen some development movements more in sort of the inner city a little bit. And so there are a lot of historic buildings there that could be converted to, with use with low-income housing tax credits to provide that affordable housing. What other types of programs are you seeing paired up with low-income housing and or historic tax credits?
The one program that comes to mind that could be twin with both LIHTC and historic is the OZ, or Opportunity Zone program. Fallbrook closed a $20 million proprietary O-Zone fund around this time last year, and we deployed all the capital over the summer. That was straight LIHTC twinned with OZ, where we were able to provide both enhanced pricing to the deal, but then a slightly out-of-market yield for our tax credit investor. And that was because of the OZ regs, which says that you get to pay, the lesser of 90% of the tax that you're deferring today at the end of 2026. Or if the value of your investment has gone down, a reduced number somewhere below 90%. And so at closing, we projected, roughly 50% of the LIHTC credits had been delivered. So there was only about 50% of the fair market value remaining. And so we're projecting that instead of paying 90% of the tax due at the end of 2026, we're paying somewhere closer to 50% of the tax due. And so that's a really good use of both programs. On the historic side for twinning with OZs, that actually becomes really compelling, where because of the inherent flip in the deal, you could argue, or one could argue, that the fair market value of the investment has gone down by as much as 90% at the end of 2026, thereby potentially permanently eliminating somewhere around 90% of the taxes that were due. And that's a pretty significant increase to return, both in terms of yield and ROI to a tax-motivated investor. And so Fallbrook's been looking at doing that with a number of different investors. Obviously it's not easy to get done with banks because banks don't frequently have capital gains that they can shelter. Some do, but it's not something you see all the time. We're actually looking at doing some with individual investors right now who are deciding between doing this program or doing, a straight 1031 exchange. The real question for an individual is, can they use the 5-year delivery of historic credits beyond deferring the gain that they're getting taxed on today? And so, that requires a pretty significant high net worth individual. But, there's one deal in particular that I was actually looking at last week. It's roughly a $4 million deal. And, it looks like we're going to structure it that way. And we're under contract now. And, it's looking pretty good so far.
Wow, it sounds like a lot of, at least some flexibility there. So it's interesting to see, we have a lot of conversations about opportunity zones, but a lot of times it's really just focused purely just on opportunity zones. It's interesting the way it's, he talked about how it's been integrated with the low-income housing tax credit program for affordable housing, and then also even layering that on top with either state and federal historic credits. So, Mark, it sounds like a lot of these tracks, either way, are, they can have some complexities and maybe not so much complexities, but inevitably there's probably a lot of stuff to navigate just pure structurally, right? I mean, in addition to all the other things that you have to track, including cash flow and allocation of benefits. So what's your take on that complexity?
Well, yeah. So none of it would be possible without people, like you and Don and Baker Tilly. I mean, the reality is that, I certainly know enough to be dangerous. Fallbrook knows enough to be dangerous, but, Baker Tilly, as accountants in these transactions, especially twin transactions, a straight LIHTC deal, syndicators can do the model all day long. But anytime you add a layer of additional subsidy, we're always looking for, firms like yours to be able to handle that, structure that, and get, tax counsel comfortable with the ultimate results, because without a should level tax opinion, we're not getting this done. And without the model, we're not getting a should level opinion.
Thanks for that, Mark. I must agree.
Well, it's true.
And thank you for coming on here. And we really appreciate, adding your insight here. And Don might have even a couple of questions to ask you.
Yeah, just Mark, I think this is, we're seeing, this is really just more of a federal LIHTC question. Everything has been about income averaging, or waiting to hear, kind of the public hearing. In the deal you just closed, are you allowing income averaging your investors, or where are you guys at with that?
Yeah, that's a good question. So on the deal that we just closed this morning, we did not, but I'd have to go back and frankly double check our underwriting to see where we're at. The reality is I think we're all planning for it and seeing how that's affecting all of our deals. It feels like every developer I'm talking to now, that's the first thing on their mind. And it's really driven by, what our investors' appetite is for a particular deal. Now, that said, one of our main investors really focuses on seniors. And so, we're not really too focused on what their income is.
Yep.
As most of them are retired, right?
Got it.
Good. No, that was good. We really appreciate your time today, Mark, and listeners. Thank you for tuning in today, and we'll be back in touch with you soon. Thank you. Thank you for listening to Buzzhouse. To receive a notification when new episodes are available, please subscribe to Buzzhouse, a Baker Tilly podcast, wherever you get your podcasts. For additional resources around multifamily housing, check out bakertilly.com. And if you have a suggested topic, please send them to build@bakertilly.com. That's BUILD@bakertilly.com.